let's look ahead. 2021, what should we expect? What are the opportunities? What are the risks? Now, before I talk about my outlook, again, please take these forecasts with a grain of salt. Why? Because no one can predict the future. No one can. I can't. All we can do is we can look at current trends and extrapolate the trends. That's it. That's all we can do. But we can't predict something that could change the trend, like a killer pandemic or an alien invasion. That's something that we can't predict. Okay? I love this quote by Warren Buffett. He said, "We have long felt that the only value of stock forecasters is to make fortune tellers look good." Okay? That's how cynical he is to stock forecasting, which I agree with him, right? Even now, Charlie and I continue to believe that short-term market forecasts are poison and should be kept locked up in a safe place, away from children and also from grown-ups who behave in the market like children. Okay, so take these forecasts with a pinch of salt. Sorry, pinch of salt. They're not a grain of salt, pinch of salt. Okay, so with that, let me do a forecast. So let's look, first of all, at the global economy. What's the outlook? Well, the outlook looks pretty confident, right? Why? The global economy is looking to continue to heal from the artificially induced recession as countries begin to slowly open up. Like in Singapore, we are more or less opened up, okay? Last year, the global economy was down like 4.8%, 5-6%. But we expect a healing from this recession due to now the widespread vaccination going on, all right? Global GDP is projected to be between 5.2 to 5.4% this year. All right, guys. So the global economy is expected to grow 5.2 to 5.4% this year. And we don't expect any interest rate hikes for the next 4 years. So interest rates are going to remain low. Money is going to remain cheap. The Fed is going to continue to pump in money. So based on the current trend, the market should continue to go up. Okay? Specifically, let's take a look at the US market, because the US market drives the global economy. And as you guys know, my main focus is the US market. 65% of all my wealth is invested in the US because it's the strongest wealth-making machine in the world. Okay? So looking at the US market, the economy is recovering, right? It's in progress of recovering. GDP is projected to be 3.5 to 4.5% this year for the US specifically. This is on the back of, again, vaccine distribution that's going on right now. Arnold Schwarzenegger just had his vaccine, I think it was 2 days ago, and said, "Come with me if you want to live. Vaccinate yourself." All right, sorry, bad impression. Okay, next. There's also a lot of confidence in the new administration focusing on combating the pandemic. So the new president, the new government in the US is now very much focused on testing, on vaccination, and on controlling the virus. That should heal the economy a lot faster. At the same time, like I mentioned, the Federal Reserve, this guy Jerome Powell, aka Captain America, is committed to support the economy with accommodative monetary policy. What does that mean? It means he's saying, don't worry, guys, we're going to keep putting in money until the economy is fully recovered. We're going to keep cutting interest rates, or we're going to keep interest rates low until we reach the promised land. All right? And the only fear would be inflation. If inflation goes too high, they may be forced to raise interest rates or cut back on stimulus. But they already said, we don't care about inflation in the short term. Even if inflation rises above 2%, it's transitory, which means it is short term. It's fine. We won't raise interest rates. So he's basically giving a blank check and saying, hey, no worries, Mr. Market, we got your back. All right. So based on this, the market should continue to rally. Of course, it won't go up in a straight line. There'll be ups and downs, but overall, it will keep chugging higher. And the other good thing is that equity risk premium remains positive. I'll talk more about what that means in a while. That basically means that stocks are still attractive relative to bonds and money market funds, okay? The other bullish statistic is that FactSet is projecting a 22% earnings growth for calendar year 2021. So companies in the S&P 500 are projected to grow their earnings at 22% this year, which is not great given the fact that it was down so much last year. So it is growing off a very low negative base, okay? All 11 sectors are projected to report year-on-year growth in earnings, led by the energy sector. So the energy sector is expected to have the biggest rebound, oil and gas. Why? Because it was in a crapper last year. Now, having said that, I avoid energy companies completely. I don't buy energy companies. I don't buy oil and gas. But I am looking at alternative energy, solar power, and hydropower and wind power. More on that later on, okay? Followed by industrial. So industrial companies are looking to grow at 78% in terms of their earnings growth, and consumer discretionary looking to grow at 58% this year. Now, how about politics? Now, of course, I have to talk a bit about politics because, some people have been led to believe that, okay, if the Democrats are in power, as they are right now, is not good for the economy because, Democrats, they regulate the economy, they raise taxes, and it is not good for the market. Is that true? Not really, if you look at the facts, okay? So looking at the last 100 years, you can see how the stock market performed under different presidents. So the ones in blue were the Democratic presidents. You have got Bill Clinton most recently, and of course, Barack Obama. Before that was Johnson, Kennedy, Eisenhower, Truman, and Roosevelt, right? And then you've got the Republican presidents. You have got Eisenhower, Nixon, Ford, Reagan, George Bush Sr., George Bush Jr., and of course, most recently, President Trump. So you can see that in the last 100 years, in general, the market tended to do better under Democrat presidents. On average, the market returned about 10% a year under a Democrat president. But on average, the market returned only 6% a year under a Republican president. So if history were to repeat, then the stock market should see 10% average gains a year under the Biden administration. Okay. Now, of course, the Democrats have taken the White House, and initially we thought that Congress would be retained by the Republicans. But now the Democrats have flipped Congress. So now the Democrats control the White House as well as Congress, Senate, and the House of Representatives. So what does that mean for the market? Well, again, historically, of course, the market performs best when it's a Democratic president and a split Congress. Well, actually, more or less, we're quite a split Congress, right? It's pretty even, all right? So you could argue that we are actually under the best case scenario, all right? But the Democrats have a slight edge because of the tie-breaking vote of the vice president. So if you take that into account, you'll be a Democratic president with a Democratic Congress, which is 9.8% return on average, which is still not bad, okay? Now, more specifically, how would this Biden administration impact policies? So, of course, in anything, there are opportunities and there are risks. So people are looking at the risks. Main risk would be Democrats are known for increasing regulation. They're going to regulate the financial industry, regulate the energy industry, and with more regulation, lower profits and lower market gains, right? And of course, the risk of higher corporate taxes. Okay, Donald Trump, of course, what we all love about him is that he cut taxes from 35% to 21% tax. So when he cut taxes, profits grow, markets go up. So with the Democrats in charge, they may raise corporate taxes again. Am I concerned about that? Again, I'm not. Why? Because looking back at 100 years, when Democrats had high taxes, the market still did really well. So, who the heck cares, right? But my belief is that they won't raise taxes that soon. They'll only raise taxes when the economy is fully recovered. And that will not be for at least 1 or 2 years. But I'm a positive guy. I'm an optimist, right? So I like to look at opportunities. That's me. What are the opportunities? So the new administration has said that they're going to focus on increasing infrastructure spending. Okay, so which companies will benefit? Infrastructure companies, industrial companies like Caterpillar, like 3M, like Honeywell. Okay, so these are the individual companies, or you can buy an ETF where you buy a basket of infrastructure companies. And the one that I'm looking at is the US Infrastructure ETF, ticker symbol INFRA. Okay. Now, bear in mind that these companies I'm mentioning and ETFs doesn't mean that an investor should buy now. Why? Because the moment Biden won, these stocks have already gone up in anticipation of these policies. So these stocks are already flying. So don't jump in after they're flown. Wait for them to pull back. Remember, it won't go up in a straight line. It'll go up and down and up again. So wait for the pullback, wait for the short-term correction to enter a position. And we'll look at that more when we look at the charts in a while, okay? The next would be renewable energy. So this is a big thing among the Democrats. They want to focus on investing in renewable energy or green power, as they call it, right? So solar and wind. Now, people ask me, Adam, which companies should I buy in the solar industry or in alternative energy? Now, here's the thing. I believe that as an industry, alternative energy and solar has huge growth potential, But I will not buy individual companies within the industry. Why? Because it is a very competitive industry. And you've got no idea which company will win and which company will lose. And because they are so competitive, many of the companies, they don't have sustainable competitive advantages. They don't have wide economic moats. And a lot of them do not have consistent cash flow. So in such a situation, I do not buy individual companies. I just buy the ETF. Does it make sense? So there are two ETFs I'm looking at. The first would be the solar ETF, ticker symbol TAN. Those of you from China or Asia, if your surname is Tan, just remember buy yourself. Okay? The other one is the clean energy ETF that invests in a basket of solar, wind power, and thermal, whatever companies, right? Ticker symbol ICLN. So again, I'm watching, these are in my watch list, and I'll enter when I see them retrace to a buy level based on technical analysis. Okay? The next one will be healthcare spending. So again, the Democrats are all about investing in healthcare. So again, I have loaded up on a lot of healthcare companies like Viva, ticker symbol VEEV, like United Health, ticker symbol UNH, or looking at the ETF, ticker symbol XLV. This is the healthcare ETF. Next will be pandemic control. So we now expect widespread testing, widespread vaccination. So with all this vaccination, what do you need? You need a lot of syringes, to inject the vaccine. Which company makes the most syringes in the world? The answer is this company, Becton Dickinson, ticker symbol BDX. This company is one of the biggest medical suppliers in the world, and they produce the largest number of syringes for vaccinations and for injections. Okay, so again, this stock has really flown in anticipation of this. So you can't jump in right away. You got to wait for the buy point for it to pull back temporarily in the next few days. So it's on my watch list. I'm watching it, ready to enter. So are my students, and I will alert you with my buy alerts and my sell alerts the moment I get into the investment. All right, and that's through the Ultimate Investors Playbook that you can subscribe for if you are interested. Okay. Let's look at some economic data. Again, take this with a pinch of salt, but then again, they do show that the economy is on very strong footing. If you look at the yield curve shows you the interest rates at different maturities. Okay, so right now you can see that the 10-year bond or the 10-year maturity, the interest rate is about 1.5%. So if you buy a 10-year bond, you get 1.5% interest rate. If you buy the 1-year bond, the interest rate is like 0.2%. So this is good news. Why? When long-term rates are higher than short-term rates, we call it an upward sloping yield curve. And this tells you that people are confident about the economy in the future. Hence, the yield curve is upward sloping. All right? If you see that the yield curve inverts this way, where short-term rates are higher than long-term rates, this is usually an indicator of a recession coming. So the good news is that the yield curve, which is upward sloping, tells us that there's no sign of a recession anywhere on the horizon. Okay. The other chart you can look at would be the spread between the 10-year and 1-year interest rate. So if you take the 10-year, minus the 1-year, if it's positive, that means it's great. If it's negative, it's an inverted yield curve. So you can see over here, it was inverted, negative, 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 negative. An inverted yield curve, where it's negative, has predicted the last 7 recessions. So in fact, before this recession in 2020, we had an inverted yield curve a couple of months before that. Maybe a coincidence, you never know, but it did happen. But where are we today? Right now, we are here. The spread is about 1.5. Sorry, it's about 1%. So we've got a positive spread, upward yield curve. Economy looks pretty darn strong. Now, what is worrying a lot of people is that the stock market looks insanely overvalued. It looks insanely overpriced if you are looking at the price to earnings ratio, which most people look at, right? So PE ratio stands for price to earnings ratio. Now, this chart shows you in the last 20 years, the average PE ratio is 21 times. So theoretically, anything above that, market is expensive. Anything below that, the market is cheap. So where are we now? As of yesterday, the PE ratio of the market, of the S&P 500, is at 41 times, all-time high. So that's freaking people out. They say, oh my God, it's so high, it's got to come down. Well, yes and no. Okay? Now, people are comparing this to the dot-com bubble. They said the only time the PE ratio has been this high was the dot-com bubble that preceded the crash. Is it going to happen again? I don't think so. Why? One big difference is the equity risk premium. What does this mean? What is equity risk premium? The equity risk premium is the S&P 500 earnings yield minus the US Treasury 10-year yield. Okay, so what the heck does that mean, right? Now, it means that the S&P 500 represents the stock market. So if you invest in a stock market now, you get a yield of 2.6%. Which means every $1 you invest, that you pay, $1 you pay, you get 2.6 cents in earnings. So is that good? Well, you got to compare it to alternatives. If you leave your money in the bank, or you put it into the fixed deposit, or you buy bonds, 10-year bonds, you're only getting a 1.1% yield. So does it make more sense to buy stocks that give you a 2.6% yield, or buy bonds, or leave it in money market funds with a 1% yield? Obviously stocks, right? So what this tells you is that stocks are still attractive relative to bonds, relative to money markets, relative to cash. If you keep cash is losing value because of inflation, because of devaluation, because of money printing. Every year you hold cash, you could be losing 2% a year because of devaluation. But if you invest in stocks right now, you're getting 2.6% yield, invest in bonds 1%. So relatively, stocks are the only game in town that can give you a decent return. That's what it means, right? So if you take the stock market yield minus the bond yield, you get the equity risk premium. As long as the equity risk premium is positive, it tells you that stocks are still attractive and money will keep flowing into stocks. Now, if you look at the dot-com crash in the year 2000, which was somewhere here, right? And if you look at the global financial crisis in 2008, somewhere here, guess what? During those two crashes, during the dot-com crash, during the financial crisis, the equity risk premium was not positive. In fact, it was negative 3%. That means stocks were not attractive at that time. Global financial crisis, the equity risk premium was near zero. But now, the equity risk premium, although it's come down a lot, is still 1.5%. So as long as the equity risk premium is positive, economy is strong, Fed is pumping in money, yeah, market looks a bit overvalued right now, but the path of least resistance looks upward. Okay, again, take this with a pinch of salt because no one can predict the future for sure. Now, let's look at the charts. I have to admit that the US market in general is overvalued. It is not cheap. It is expensive. Okay? But having said that, within the market, there are still companies, pockets of companies, good companies, of course, that are still reasonably priced. So as an investor, you have to know exactly which companies they are, and to only buy those. And for the overall market, I wouldn't jump in right now. I would not jump in right now. I'll wait for at least a 5% to a 15% correction before buying more. Okay, so let me show you the charts so you can see visually how extent the market is right now. Okay, so I'm going to show you the S&P 500. And let's look at the long-term chart. So I'm going to show you the 10-year chart. Okay, so this is the 10-year monthly candles. You can see the market's always on a very clear uptrend. All right. Now, remember that the market will always go up, always, but it will not go up in a straight line. It moves in wave patterns. We call it impulsive and corrective wave patterns. So this is how the market moves, right? Wave up, wave down, wave up, wave down, wave up, wave down, so on, so forth, wax on, wax off. So it's kind of like a breathing pattern. I keep saying this in every webinar, but it's important, right? So breathe out, breathe in, breathe out, breathe in, breathe out, breathe in. Now, it's like a breathing pattern. Can you breathe out forever? No, you can't. You will run out of air, right? You can't breathe out, you run out of air. You got to breathe in eventually to breathe out again. That's how the market works, okay? So look at these wave patterns. The thing to understand is that sometimes the market takes a shallow breath and sometimes it takes a deep breath, okay? So shallow breath, shallow breath, shallow breath, deep breath, shallow breath, deep breath, okay? Now, we can't predict exactly when it will breathe in, but we know historically the market will have a shallow breath at least once a year. Once a year, you will have a correction of at least 5%, right? At least 5%. And once every 2 years, you have a correction of about 10 to 15%. And it's part of the game, it's part of the breathing process, right? Now, once every 6 years, well, 6 to 8 years, once every 6 to 8 years, you have a deep breath. We call this a bear market. We call this a bear market, and we just had one last year. So I don't expect another one for the next 6 years, all right? The bear market is where it drops 20% to about 35%. Okay, so that's what you got to understand. This is the cycle of the market. You got to expect it will happen. Okay, so if you take a look at the market right now. Oh, by the way, let me ask you a question. When do you want to buy? Breathe out, breathe in, breathe out, breathe in, breathe out. Do you want to buy? Do you want to buy at the breathing in or buy at the breathing out? A or B? Give me your answer. Type your answer, guys. Would you rather be a buyer at A or B? A or B? Type A or B. That's right. Everyone says A, right? We want to be a buyer during a breathing in. We don't want to jump in at the breathing out. So never chase the stock, never chase the market, never chase the girl. Let the girl run into your arms. Okay? So if you look at the market right now, from a long-term perspective, what do we see? Right? We can see, breathe out, breathe in, breathe out, breathe in, breathe out, breathe in, breathe out. Deep breath. Breathe out, breathe in, breathe out. Deep breath. Breathe out, breathe in, breathe out, breathe in. Deep breath. Breathe out, breathe in, breathe out, breathe out. That's right. Now we are breathing out. We are breathing out right now. Okay? So you want to wait for breathing in, breathe in to start re-entering the market. So the question is, when it breathes in, where would it stop before breathing out? We can't predict for sure, but we can guess by looking at historical support patterns, support levels. So you can see, for example, you can see historically when the market breathed in, shallow breath, it touched the red dotted line or near the red dotted line, right? The 20 EMA. Can you see that? Can you see this red dotted line? And during a deeper breath, you'll touch the blue line. That is why, notice I've drawn a level here, 3219. This is a buy level, 3219. This is another buy level, 2979. So am I saying that I would only buy when it reaches this level, for example? No. Why? Because again, remember that it will only drop to the blue line once every 6 years on average. So if you wait for the blue line, you only buy 6 years from now. Okay? But we can start buying during shallow retracements. During these shallow retracements. So for that, let's zoom in and look at the weekly candles. Let's look at the weekly candles. So these were the first two buy levels I talked about, right? These are the bigger corrections. But on a shorter term, you can see a support at the red dotted line and blue dotted line on weekly candles. Can you see? So again, breathe out. Oops, sorry. Breathe out, breathe in. Breathe out, breathe in. Breathe out, breathe in. Breathe out, breathe out. Don't buy the breathing out. Wait for the breathing in. Breathe in. Yep, 3595. I could add a bit over there. And if it has a deeper breath to 3427, that could be another level to add. So in investing, we never buy at one go. I tell my students, if you want to invest $100, don't buy $100 at the first level because it could go deeper. Buy in tranches. So for example, at the first level, you could buy $25 worth of shares of $100, for example. You buy a quarter position, right? And then the next level, you buy another 1/4, and then you could buy another 1/4, and you average in your position. This is for investing. Of course, for trading is different. For trading, you just enter once and put a stop loss. If it hits the stop loss, re-enter again at the next support. So depending on the style. But you get the point. But the point I'm making is that if you look at the market, it is right now overextended. Overextended. You got to wait for a drop of at least 5 to 10% before it's reasonable to add shares again for the S&P 500. If I zoom down closer to daily candles, let's look at the daily candles over here. Yep. You can see, right? Breathe out, breathe in, breathe out, breathe in, breathe out, breathe in, breathe out, breathe in, breathe out. We're going to breathe in. That's right. So you're going to let it breathe into at least this level over there. Got it? Okay, so that's how I use charts to kind of like time my optimal entries so I don't overpay for the markets. So what's my overview and strategy for the US markets? Number one, I expect positive but lower returns for this coming year. Why? Again, remember, in the long term, the market returns 10% a year on average. Last year, we were up 15%. In 2019, the US market was up 28%. So after 2 years of exceptional returns, I don't expect this to continue. Logically, we should have a reversion downwards towards the long-term average of 9 to 10%. So there's a high probability of a correction back to the moving averages. In other words, we should have a breathing in that's healthy. Okay? Expect it. Don't be afraid of it. Get ready to buy shares when that happens. Of good companies, of course. Yeah? I will only deploy more cash into the index ETFs if there's a correction of at least 5 to 15%. That's what I said. All right. Now, am I buying right now? Yes, I am. In fact, yesterday I did buy some shares. I did buy the day before. Those of you in my chat group, in the Ultimate Investors Playbook, you can see my live buys and sells, right? Why? Because there are still pockets of fundamentally good businesses that are still fairly priced, and some that are still underpriced because of short-term negative issues affecting those companies specifically. Example, Lockheed Martin. That's one of them, ticker symbol LMT. Facebook, I was buying last week because of the short-term problem of their WhatsApp terms and services, right? Amazon, I bought more Amazon recently as well. United Health, still undervalued. Microsoft, I bought a bit more last week as well. And Salesforce. So I've been adding shares of these companies because these are great companies that are still not that expensive yet because of short-term issues, giving me an opportunity to add these shares. Okay.